Through with one part of the revision, and now we are going to the next part where we are supposed to finish off bank audit and then move on to the NBFC. Okay guys, I understand it's a big one, and to cover all the concepts, each and every concept, it's a difficult thing. Let's see guys. So we saw the critical portion of bank audit chapter. Now let's see the remaining part, which is comparatively very easy and straightforward. Let's see. So the introductory part, that how certain characteristics of a bank distinguish them from others. It's pretty simple, straightforward. Uh, so the shortcut is bank audits like it is to cross the deadly desert. What is so special? What is so different in banks as compared to other entities? So C is for very complex set of transactions. A lot of different systems are involved. Core banking system is involved, internet is involved, Android is involved, OS is involved, Windows is involved, different architecture, cloud is involved. Because there's a lot of use of IT, obviously the way transactions happen, secured servers are involved, credit card, debit cards are involved, point of sale machines are involved. So many devices, so many technologies, and real time things are happening. There are multiple things there to ensure that there should not be failure. So it's a complex thing. There is a lot of complexity. Then regulator, RBI plays a very important role. There are loads of regulation for different things banks do, right from the start, licensing or opening branches or giving services. So lot of regulatory influence as compared to others. Complexity is more, regulatory influence is more, regulations are more. Off balance sheet items, many things like giving guarantees. There are a lot of things which may not appear in balance sheet, but they may appear in notes to accounts, and a big part is contingent liability, guarantees, letter of credits, comfort letters. That is a big part which appears in notes to accounts. So again, this is different from others. Then security, security holds big importance. They are in custody of so much of cash, so much of cash, so much of investment certificate, so much of high value things, that it becomes extremely important to have the physical security of those items, to maintain them properly, physical security, keep a proper record, regular physical verification, and so on. Systemic risk. Sometimes banks are so big that if they collapse, they can affect the whole system. Systemic risk means they can affect the whole system, they can slow down, they can puncture the whole system. That is the big risk, that your failure can affect the whole system. Decentralized operation, there is a big network of branches. Dispersed transaction, part of the transaction is done by one branch, part of the transaction is done by the another branch. Direct customer transactions, so customers can transact in different manner. They can initiate through ATM, they can initiate through app, they can initiate through website, they can initiate through mobile phone, they can initiate n number of transactions, execute them. So what makes them different is it's like crossing the deadly desert. There's a complexity, there's a regulatory influence. For off balance sheet item, as for security and custody is a big issue. Systemic risk is there, decentralization is there. D again stand for dispersed transaction, and desert, direct customer transactions. Okay, so this is how bank is different. This is how bank is different from others. Okay, now special audit consideration. So that is what special things we need to do in audit of bank. So unique, Tara, is the a unique risk. Definitely, we have just understood that the nature of business is quite different as compared to others. So the nature of risk are quite different. For example, there's a custody of large cash and huge investment. So there is a risk. There is a risk that it may get stolen. It may get stolen. There is a risk that during commutation it may get stolen. So they have unique risk. They have huge custody of cash. They have huge custody of lockers. So there's a risk that these things uh, these things may go in hand of the unauthorized people. So the nature of risk is completely different. There is a big use of technology. Huge transactions happen through technology. Again, cyber attacks can have a big impact. It can lead to thousands of crores. The nature of risk and the quantum of risk in banks is quite different from others. So we need to specially understand those risks and plan for it. So the risks are pretty different. So it's important that in audit we understand it's a different unique risk and plan how to do examination in these risky areas. Then apart from that, tech dependency is huge. So we need to ensure, we need to spend a lot of time in checking whether the IT systems are appropriate or not. Auditors knowledge, we need to have thorough knowledge of what different services they are giving, what different types of deposit services they are giving, with savings account, current account, recurring deposits, different types of deposits, automatic FDs, what different FDs they are giving. Apart from that, what are they selling? Insurance also? Are they giving security services also? Buying and selling securities? We need to understand different products they are giving, different services they are giving, how they are giving it. We need to pay special attention to what are the regulatory requirements and whether they are being complied or not, and if not, what's going to be the impact. Tara, A stands for application integration. Different banking application and ensure interface controls are robust. A lot of things happen through apps, applications, softwares. We need to understand special focus whether these applications are working properly. So there are unique risks. We need to plan for how to perform audit in these risky areas. There's a lot of tech dependency, so we need to spend a lot of time in checking the tech. Then auditor needs a lot of knowledge about the bank products and services, what they're giving. Then auditor need to understand the regulatory requirement of RBI. Special consideration that this is what we are supposed to do. We need to understand whether there's so many applications for to do transactions. Are they working properly? So banks are different, and that's why they demand a different approach, a little different approach in audit. Now, if you go, we should be aware. We should be aware about. We should be aware about different laws applicable to a bank. So we have divided it in two parts. So first one are laws which were made to increase the reach of banking in India, and the laws were made to improve the banking services. Let's understand, guys. In 1934, RBI Act was brought in. Okay, 1934, there was a RBI Act to make RBI as a central bank, as a supervisor, as a apex bank. That was really great. But then in 1949, Banking Regulation Act was passed to make RBI powerful. In 1955, we wanted banking to reach to everyone across the nation. So we made State Bank of India Act. But then again, we wanted more banks for the people. So 1959, we made State Bank of India Subsidiary Act. And then in 1970, again, we wanted more banks. So private control was taken and government control was imposed. Banking Company Acquisition Transfer Auditing Act 1970. 76, we wanted more banks for our people. So there was RRB, Regional Rural Bank, especially in rural area. Then again, we wanted more banks to reach people. So Banking Company Acquisition Transfer of Act 1980. So 34, we got RBI. Then 49 we got banking regulation, 55 we got SBI, 59 we got State Bank of India Subsidiary Act, 70 we got Banking Company Acquisition and Transfer of Undertaking, 76 we got RRB, and then in 80 we again got Banking Company Acquisition and Transfer, BTU, ATU, Banking Companies ATU Act. Then to improve quality in 2000 we got in 2000 the important act which was very important for banks so that they can establish their online systems. To 2000 IT Act. These are the acts which are applicable to banks and we should be aware about when we go for audit. Okay. And so for the purpose of retention, we have divided in two parts. 2000 IT Act, 2002 PMLA, Prevention of Money Laundering Act, 2002 SURFACE, Securitization and Reconstruction of Financial Asset and Enforcement of Security Interest Act, 2002, 2007 Payment and Settlement Act, 2013 Companies Act, and then we have Cooperative Society Act, and then Cooperative Society Act. So guys, so here 2000 in IT Act, 2002 PMLA, 2002 again two times, 2002 is two times. We have SURFACE Act, 2007 Payment and Settlement Act, 13 Companies Act, and then Cooperative Society Act for cooperative banks. So these are different laws which are applicable to banking to different banks. We should be aware about them because while we do audit, we'll have to ensure that sections of this act which have direct impact on the business of the bank, on financial statement, we need to ensure that they are complied with, because there's a non-compliance, there can be big implications. Then we talk about form and content of financial statement. So we have banking regulation, we have banking regulation act. In that we have in Banking Regulation Act section 29, they say section 29 they say that format is given in Banking Regulation Act third schedule. It is given in third schedule. And in third schedule you have Form A, Form B, Form A for balance sheet, Form B for P&L. So formats of the financial statement is given in Banking Regulation Act, and as per section 29 it is given in third schedule. There is a Form A and Form B. Apart from that, they are also, if they are listed on stock exchange, SEBI regulation will also get applicable. The most important law for them is Banking Regulation Act. Then if they are listed, then SEBI regulation will get applicable. So this is about the format and the content. Then accounting should be done as per accounting standards under section 133. It's very important to note that it can be targeted in MCQ. That applicability of Ind AS is deferred. As on today, it is not applicable to banks. Then we talk about preparation. They need to prepare standalone financial statements and consolidated financial statements. PSU banks, standalone statement, consolidated branch account, especially national and public sector banks. In private bank, there is centralized accounting and no mandatory branch audit is applicable. So what is the difference, guys? Again, there can be MCQ on this. See, when we talk about format of financial statements, it is given in Banking Regulation Act and also governed by SEBI regulation. So this is 1A, 1B. These are 2 points. But then when we talk about basic accounting, they need to follow accounting standards as approved under 133. All of them need to follow. They do need to follow Ind AS. And further, after doing the basic accounting, they need to prepare both. They need to so basic format and accounting 1A, 1B, 1C. Then preparation, they need to prepare standalone and console financial statements. A very interesting part, in PSU, accounting is done at head office, and then there's a decentralized accounting at branches. And generally there are separate auditors for the branches also. A lot of branches are audited by different branch auditors. So there, to prepare consolidated financial statement, to prepare standalone financial statement, trial balance and financial statement of branches are consolidated. So in PSU banks, there is a feature that branch trial balances, branch financial statements will be consolidated to prepare the standalone financial statement. This is a special feature in PSU bank, but that doesn't happen in private banks, because in private bank they have centralized accounting. They have centralized accounting. So because they have centralized accounting, so generally a trial balance of the whole bank is prepared and financial statement for the whole bank is prepared. It is not done branch wise. That's a basic difference, the way accounting happens in PSU bank and private bank. And that is why, because of that, there's a basic difference how audit happens. In PSU banks, you will have branch wise audits. In private banks, you are not going to have branch wise audit. Very important from MCQ point of view, this will be targeted. Now, audit is mandatory. Yes, audit is mandatory, but then the question is, who is going to do audit? So as per section 30 of banking regulation, the person who is eligible to do audit as per Companies Act, the same person is going to do audit. Same person is supposed to do audit as per the Banking Regulation Act. So as per Companies Act, chartered accountants can do audit. So the same people will continue. What about appointment? Let's see. The biggest bank is SBI. So SBI, below that we have banking companies, below that we have nationalized banks, below that we have regional rural banks. So we have arranged it in a sequence, so it's easy to remember. So we first talk about SBI, below that banking companies are big, then below that nowadays nationalized bank has gone below down, and then we have RRBs. So the biggest bank, CNAG, Comptroller and Auditor General, in consultation with central government. So when it comes to biggest bank, the biggest auditor of the nation, CNAG, they are going to appoint and they are going to consult central government. So appointment is a crucial thing. So always two entities are involved. In case of banking companies, appointment will be done at annual general meeting, but there will be prior approval from RBI. Again, two people are involved. Two entities are involved. Nationalized bank, government appoints board of directors to manage nationalized banks. So they are only going to appoint, but again prior approval of RBI is required. Two of them are required. Then RRBs, when we talk about RRBs, the RRB itself will appoint, but approval of central government. When it comes to RRBs, there is, because this scheme was brought and enforced by central government is involved a lot. So the biggest bank, then the banking companies, nationalized bank and RRBs. Bank appoint multiple firms of chartered accountant as SCAs, statutory central auditors, based on size and board decision following RBI guidelines. So RBI says that okay, you appoint, and it will be great if you appoint joint auditors. So we are discussing things one by one. We have discussed who is going to, we have discussed, the first point we discussed was qualification. The next point is who is going to appoint. The third point is joint audits. Joint audits are promoted. Then once appointment is done, appointment letter will be sent and it is going to have all the details. It is going to have all the details with previous auditor and what procedure need to be followed. And after appointment letter, auditor is supposed to send. So this is the procedural part, letter of acceptance, that yes, we are accepting the audit. Apart from the regular audit report on financial statement, we have already seen italics, lot of different reports and certificates will be required. So these are very basic things. Who can do the audit? Appointment of auditor, appointment of joint auditor. After appointment is in sequence. Who can do the audit? Who are going to do appointments? Appointments are going to be joint audits. After appointment, letter will be sent. Then letter of acceptance will come, and at the end, a lot of different reports and certificates will be given. Now, conducting audit, again, I expect maybe MCQs, or I expect small cases from here. Okay, let's see. So conducting an audit. So they explain that the first step is initial consideration. What things we need to do initially. That is stage 1. Then stage 2 is we need to understand the bank. Then once we understand the bank, then we are going to get risk. Once we get the risk, then we are going to perform audit procedures, execution. And once we perform audit procedure, Okay, after getting evidence, the next stage is reporting. We have already discussed reporting in the previous uh, lecture. Let's see, guys. Now, initial consideration. Initial consideration, guys. So, as bank audit is offered, auditor should sit down and carefully analyze the assignment. Just like we do it in quality, just like we have to do it as per SQC1 and SA220, sit down and analyze the situation. Okay, understand about the integrity of the other people, then understand about your competence, and then carefully decide whether to accept or not. So the initial stage, we will carefully decide whether to accept the assignment, whether to continue the assignment. If the answer is okay, we are going to do it, the next thing is we should communicate with the previous auditor. We should communicate with the previous auditor that we have been offered the assignment, and if you have any objection, please let us know. So we are supposed to communicate with them and obtain, most preferably, NOC. Is NOC, no objection certificate, will be good. Then we have to declare indebtedness. We need to declare them. Okay, before appointing, auditors are supposed to submit declaration of indebtedness, obtain declaration of indebtedness, written confirmation that auditor, firm, partners, family have not been declared as willful defaulter by any bank and financial institutions. So okay, so first need to tell that are we indebted. Then we further need to tell are whether any of us is declared as willful defaulter under banking regulations. Okay, and then are we disqualified under Companies Act. So we need to give declaration how much indebtedness we have. Is it within the limits? Are we declared, whether we fulfill Companies Act, whether we are qualified and not disqualified as per Companies Act, and then also whether we are declared willful defaulter. So first, carefully, whether we want to accept and continue. If answer is yes, communicate with the previous auditor, tell them about your indebtedness, about your qualification, disqualifications, everything that you are eligible. Then, very important, you may get a case on this. Very important, you may get a case on this. We cannot perform any internal assignment. Statutory auditor cannot perform any internal assignment. Very strict. So just like in companies that we have prohibited services, it is stricter than that. We cannot be performing concurrent audits, internal audits, or any internal assignment of the bank. Okay, we only need to do statutory audit. Then finally, terms of engagement will be signed. Engagement letter giving the responsibility of the bank and responsibility of the auditor will be signed as per SA 210. Once that is done, planning will be done. Overall planning, nature, timing and extent extent of resources required, nature, timing, extent of the initial plan will be made, and then engagement team will be constituted. A good composition engagement team will be constituted. So guys, it's to be very honest, there is no such question that you explain stage 1, stage 2, stage 3. There is no such question. So no need to pay a lot of attention. Simply go through that. Just have an overview that initially we thought about whether to accept or not. When everything was fine, then we communicated. Then we declared about indebtedness. We declared about the assignments about the indebtedness, that we are within limits. We are not disqualified. We are not performing any other assignments. Then we made engagement letter. Then we went for planning, and then we constituted the engagement team. So the first stage, we are ready with our team. The next very important thing is understand the bank and its environment. We need to understand in which region they are established, from where they get their deposits, who are the main depositors, corporates or individuals, what they do. Then we need to understand what kind of loans they give. Are they good in the vehicle financing or real estate financing or project financing, what kind of financing they do, what kind of investments do. We need to understand the business of the bank. We need to understand the business of the bank and its environment. Then we need to understand, then we go and understand their internal controls as well. Are they having good established internal controls? Are they properly followed? Then below that, what kind of accounting process, which accounting software do they use, how they, whether it is accounting process well designed, vouchers, primary books, secondary books, then the trial balance and the consolidation. We need to understand the accounting process. And then once we understand the risk management process. Are they identifying risk? Are they identifying risk? Are they measuring risk? Are they classifying risk? And are they taking proper action for the risk? Are they keeping it within the limit? So I will say that first go and understand the business of the bank, then you go and understand the risk management, then the internal control system, then the accounting process. So this particular flow will be good. Okay, now when we talk about the risk management, the most important thing is the policy. There should be a risk management policy in the TCWG. Those charged with governance and key members of management, okay, CEO, CFO, they should be involved in making risk management policy. They should make list of the risk, that these risks may affect the bank. They should make the list of the risk. They should classify the risk, that these can be high, medium and low risk. They should also define, this is the maximum limit, this is maximum level of risk which we can face, acceptable level of risk. And they should assign committees. Okay, that these committees are going to take care of the risk. So the first thing is that there should be a risk management policy. TCWG and key management people should be involved in preparing them. In that, it should be clearly specified. This is the list of the risks which may affect the bank. There are a lot of risks. There can be legal risk. There can be capital adequacy. There's capital adequacy risk. There's a legal risk, capital adequacy risk. Employees may do fraud, operational risk, credit risk. There may be default, investment risk. N number of risks are there. So have the list, do the classification, make the maximum. This is the maximum risk we can bear, and assign committees that these guys are going to take care of things. Then the risk management process starts. So this is how the risk management system within the bank should operate. They should have a policy. Then they should start identifying the actual risk affecting the bank. They should start measuring it. They should see whether it is within acceptable limits or not. And then they should design control activities. Now, these are the control activities generally for operational risk. There should be segregation in all crucial receipts and payment. It should not be with one person. There should be segregation of duty. Okay. Then there should be physical security of the assets. There should be segregation of duty. If you see by common sense, there should be segregation of duty. Then there should be authorization. There should be proper authorization. First go for segregation of duty. Then physical security. Then when transactions start, there should be authorization. There should be proper recording. There should be regular reconciliation. All the unusual things should be probed into, and so on. These are the control activities. Monitoring on quarterly basis, monitor the risk management process, whether the list of the risk the list is appropriate, the risk of list is appropriate, whether classification is appropriate, whether the measurement technique is appropriate, whether the control activities are appropriate. All these things need to be evaluated and improved upon. Finally, at the end, there should be reporting. There should be internal report on the risk. There should be external reporting. In annual report, a detailed reporting is done with respect to risk. What are different types of risk, and what is their level, what is their exposure, what wrong things can happen, what is our approach, how we are controlling them, reducing them, and so on. So these are risk management systems. So in stage 2, we need to understand bank, what their banking business and its environment. We need to understand their risk management process. What is their policy? After policy, their risk their risk management process. then how they are controlling it, how they are monitoring it, and how they're reporting it. After risk management, so first comes their business, then comes risk management, then comes internal control, then come accounting. So in stage 2, we spend a lot of time in understanding everything. Once we understand, we go identify and assess risk of material misstatement. We also identify where there is a fraud risk as per 240, whether there are any pressures and any triggers which can lead to fraud risk, money laundering risk. Then specific risks, the specific risk, like there can be specific industry risk, like there can be risk of theft, there can be risk that employees withdraw a lot of money, they run away with money, they default get money. These are industry specific risk, IT risk. So identify and assess risk of material misstatement, then identify risk of frauds, including money laundering, then identify specific risks, industry IT risk, then whether there is outsourcing, whether there is a risk in outsourcing. So identify different types of risk out here. So see, understand the broad thing. Stage one was all about accepting and preparing the team. Stage 2 was all about understanding. Stage 3 was all about different types of risk. Stage 4 is finally you go and sit with the team, everyone share their knowledge, what kind of understanding they've obtained, what kind of risk they have come up with, what is the level of risk for different risk, what are the internal controls, and then how they're supposed to proceed ahead. Then after the engagement team discussion, okay, they should proper response to assessed risk. If there's a financial statement level risk, make your team stronger and includes in general surprise elements and better audit procedures. If there's an assertion level risk, then assertion level audit procedures. There should be further audit procedures, test of control and substantive audit procedures. Establish overall audit strategy. Overall audit strategy should be there. We have already discussed in SA 300. Overall audit strategy, that what are the broadly what we are going to do, more test of control, less substantive audit procedure, more dependency on IT, and so whatever strategy we have decided, okay, whether to go for monthly, quarterly or half yearly audit, make overall audit strategy. On that basis you are supposed to make plans. Then audit planning memorandum is like an outline, is like a summary. It's an outline, it is summary of what audit plan we are going to execute. So this outline should be there with everyone. They should understand overall, have an overview, what kind of audit we are going to do, what kind of risk we are going to emphasize more. Okay, so audit planning memorandum is like a summary of the audit plan. We make strategy, on that we make detailed plan, and we also make a summary so that the team members and seniors have an overview of what kind of audit we are going to do. In the same process, we determine the audit materiality level which will be used for doing the audit. And we also, apart from that, we also focus on going concern. So stage number 4 is pretty simple, that is execution. So after getting different types of risk, we come on execution. And when we come on execution, okay, first there is a team discussion, then we make list of risk at the different levels, then we make so we sit and discuss things, we make the list of risk, we have overall strategy, we have detailed plans, then we have a summary of that, audit planning memorandum. In the process we decide materiality, and we need to also ensure that we have special focus on going concern also. Stage 4 is about reporting. We have already discussed reporting, we have seen that part where whole 700 series is applicable. Okay, now, so guys, this is, I understand a lot of theory involved, but then, okay, what lot of theory involved, just have an overview of it, just have an overview. You just have overview of these things, then focus on the Q&A. That will be sufficient. And this video will be available. This is in short, it will be available, and you go and listening to this video again, especially one day before the exam. Things will be fresh in your mind. If they ask theory, you will be able to write it. If they ask any particular small case, you will be able to write it. Just think about it, how 4-5 mark question can be drafted, and focus on those points more. And in at some places where you can write on your own, it's absolutely fine. Go with your own thing, because it's very difficult to remember such bulky things. Now, special consideration in IT environment. So there's a lot of IT. Okay, IT. So first, auditor should go and collect information. Not very important. Need to understand the IT structure. How many locations are having IT environment, automated environment? What processors are automated? What processors are manual? So understand the understand location wise IT involvement, then understand whether IT department is centralized or decentralized, then how data management happens, where is data saved, where is it processed, its security, then what kind of internal controls are there, IT controls, accounting controls, financial controls. Okay, and whether these controls make regular reports, monthly MIS, exception reports, error reports, and are we having proper business continuity plans if disaster control plan, if something unusual happens, whether we have proper backups. So go and understand. So it's very simple. Go and understand the IT structure of the bank, data management, what the overall IT structure within that, how data is managed, different controls are there, what different reports are there, and continue. So this basic understanding, not very important. Then key security control aspects. It's very important to have good IT controls. It is very important to have good IT controls and to keep whole IT system safe. The keep whole IT system safe. So there should be some important controls. Okay. Data shortcut. Data. Let's understand. Now, data is the shortcut. So there should be good IT controls for data. So data is the shortcut. Data integrity and availability. There should be good IT controls to ensure that whatever data they are having, it's original, approved, valid data without any manipulations and adjustments. It's properly stored. It is properly stored. It is available for access, for processing whenever is required. So ensure there should be strong controls for overall data integrity and availability. Then A stand for amendments and access. There should be special IT controls whenever there is amendment on overall operating system or application controls. There should be strict controls that only authorized amendments and changes should be done. Unauthorized changes and controls should not happen. Ensure access control. Only authorized people should be physically accessing the IT department, and IT department, there should be permissions, there should be log, there should be CCTV, online access, there should be encryption, there should be passwords, and when people access, there should be segregation. Everyone should have limited access which is required for performing their duties, and not everything. Okay, limited access to the ledger codes. So ensure that the amendments in the system and access controls are pretty strong. So first D is for data integrity, completeness, availability is important. A for amendments and access control should be strong. Then T for transaction monitoring and verification. On the system should be planned in such a manner that there should be automated systems monitoring receipts, payments, changes, whether anything unusual is there. Manually monitoring should be done whether everything looks fine. On regular basis, some manual calculation should be done. And then finally, the accounting, ensure that the general ledger accounting is complete, is accurate. And generally there are subsidiary books, whether subsidiary books are properly maintained, subsidiary books for deposits, for advances, for investments, and so on. So data should be complete, integrity, availability, amendment and access control should be strong, transaction monitoring should happen, and accounting should be strong. So guys, just have an overview. This can be there, that in IT environment, these controls should be available, data controls. Then internal audit and inspection. So this is a very important department. There is a uh, central audit and inspection department, chief audit executive. Different types of audit happens in bank. So we have we have statutory audit, we have internal audit, we have concurrent audit, we have revenue audit, different types of audit. So there should be internal inspection and audit department, internal audit and inspection. Central audit and inspection department in bank is a combination of centralized function with some level decentralized and headed by chief audit executive, responsible for risk-based internal audit. Generally, all the audits, whether it is statutory audit, it is risk-based nowadays. They say that internal audit also should be risk-based. There should be identification that in which particular branches internal audit should be made mandatory, what kind of scope, what kind of auditors we need, what kind of scope should be there, what kind of procedure should be there. Okay. It is responsible for identification of branches for revenue audit, appointment of concurrent audit, deciding the scope and meeting of concurrent auditors, discussing their issues, conducting trainings if needed. The primary function is to ensure that the audit function is handled smoothly and effectively and efficiently. Then, so guys, basically, there is a inspection and there is a inspection and audit department, IAD. There is a inspection and audit department, IAD. The head is chief audit executive, and that department needs to ensure all the audits, all different audits are properly done. The important being the first internal audit, then below that concurrent audit, below that revenue audit. All these audits come under them. Ensure that these audits are properly done. So we have inspection and audit department. So first thing we need to explain, we have inspection in banks, we have inspection and audit department. In that you need to explain there's a chief audit executive. There's a chief audit executive. In that you need to explain that it's their responsibility to ensure that audits other than the statutory audit. For statutory audit committee plays a very important role. So that the internal audit, concurrent audit, revenue audit, these audits are performed properly, especially then we discuss about internal audit. So we give overview of this particular department, and then we talk about risk-based internal audit, that the risk should be identified. Then for all the businesses, whether their control systems are there. Okay, so identification of the business risk, whether controls are there. Then finally, after applying controls, then after applying controls, what is the risk at different levels? What are risk different levels? Then for different risk matrix is nothing but a table. Matrix is nothing but a table where at one side you write internal controls, and other in rows you have internal controls, and then in column headings you will have different risks which they are compensating. So in internal audit, first go and identify the business risk, then understand which controls can compensate things. After compensating, what is the residual risk, and then finally which controls are playing important role, go and test them. So it's a simple thing. In internal audit, our main focus is the internal controls, whether controls are operating effectively, are they compensating the risk. Not very important, guys. Just remember about the department, that's going to be fine. Then, so the initial part, guys, the initial part was all about how banks are different, what special things to do in the bank, how the bank audit is conducted overall, then what is the impact of the IT, what controls are required, and so on. Okay, now we have discussed a lot about risk. Now internal controls. Banks should have their own very strong internal controls. Then only they'll be able to compensate the risk. They'll be able to protect themselves. So we have general controls. let's understand this, guys. Just a minute. Just a minute, guys. Okay. So, what kind of what kind of internal controls should be there? Should be there in a bank. So, there are general controls overall, what kind of control should be there? That discussion is there. Then, apart from that, what kind of controls should be there for managing the cash? What kind of controls there should for managing clearings, check clearings? What kind of control should be there for managing bills of collection? Then managing bills purchased, then loans and advances, then for demand drafts, interbranch, credit card operations. So there's a list what kind of controls, what kind of steps are there. Okay, now, so in general, the internal controls in the bank should be strong, so as to protect the bank from different types of risk. So we have made a very simple story. So in the first character, in the first character, there is a bank manager. There's a bank manager performing his duties. So through his character, we will understand what kind of general control should be there. So general control means overall controls. Not we are not talking about a specific thing. Then there's a store in charge. Again, we understand what kind of control should be there. Then there's an employee. So divided in three parts, just to so that we can have better retention. So bank manager is there. He's having so bank manager is there and he's having certain financial powers. So there's the first point. In general, in banks, it should be clearly defined what are the financial powers of different set of people. Like there are people who will be able to approve loans up to 25 lakh rupees, then up to 50 lakhs, then up to 1 crore, then up to 5 crores, then up to 10 crores, and so on. In general, in banks, there should be financial powers should be carefully decided. There should be authority matrix that who is going to approve what level of transactions. Everywhere there should be proper financial power. There should be proper financial power distribution. Okay. So in general, in banks, in all the departments, carefully financial powers should be decided. Then there should be clear definition of the financial powers, and it should be complied with. There should be job rotation. On regular basis, there should be job rotation. In job rotation, one per so we regularly change the people who are performing different jobs. So because with the help, this is very important, because when a new person comes in to perform that area, he automatically checks whether the previous work was proper or not. There should be regular job rotation, so that work of one person is checked automatically by other, and everyone is aware this is going to happen. So it prevents manipulations, because they know they will be caught. So job rotation is wonderful preventive and detective control. It prevents and detects fraudulent activities. There should be insurance in general. All the important assets should be identified, and there should be insurance for that. And on regular basis, head office should perform a surprise inspection, and bank staff should cooperate. So when we talk about bank manager, he's having financial powers. So there's a point of financial powers, well-defined financial powers of different set of people. He ensures job rotation. That's a very good control. He ensures insurance of the branch. That's a very good control. And the surprise inspection should happen, and there should be cooperation. Okay. Now, so these are general controls should be there in all the departments of the bank. Then for all that, then there's a store in charge. He is having two things. He's having bank forms. So they should be well defined, properly designed forms. They should be pre-printed. It should be pre-numbered. It should be kept in good proper security, proper records, all the bank forms. And all the books of account should be, confidential, especially confidential books, signatures. Lot of things get approved because of signatures, so signature books should be kept confidential. It should only limited people should have access. Reliable senior people should have access. Telegraphic codes are used to instruct the other banks and branches to transfer money electronically. Those codes, even those codes should be kept confidential. Okay. So when we talk about manager, a lot of general controls come to our mind, because the kind of things bank manager does, a lot of general controls come to our mind. Store in charge, two types of general controls come to our mind. Okay. Employee work, everything should be designed in such a manner that work of one person should be done by another person. Work of one person should be done by another person. Okay. Then lot of this theory is written many years back. So lot of communication between the branches happen through mail, they're saying. So there should be a person, educated, well-educated, reliable person responsible to open the mail, to segregate it department-wise, to check authenticity of the mail, to check the signatures, and arithmetical accuracy of the books. So when we think about bank manager, we think about financial powers. There should be general control about it. We think about job rotation. It does on regular basis. Insurance and surprise inspections. Without store in charge, forms and confidential books. Employee, checking of one person by another. Then someone managing mails and arithmetical accuracy. So these are the general controls. These are the general things which should be there in all the departments of the bank to ensure that things are happening systematically, completely, accurately. Then cash controls. Cash controls. Let's understand this, guys. So first of all, the custody of the cash. Cash should not be in custody of one person. There should be two persons. It should be joint custody. There should be always a joint custody of the cash. Two or more people should be responsible. Responsible for ensuring the safety of the cash. Okay. Daily there should be test checks on sample basis. On sample basis, you may go and count the cash, and periodically there should be full counting of the cash. And this should be done by people other than those who are having the custody or handlers of the cash. And we need to match whether this cash is as per books of accounts. High value transactions of the cash should be verified by higher officer. And so first of all, they talk about custody. That custody should be with two or more people. Then there should be periodical there should be daily basis, sample basis counting should be done, periodically full counting should be done. And then, so there's a custody and how counting should be done. Then overall management, how high value transactions, currency transfers should be verified by the higher authorities. So cash custody should be with the safe people, and big changes and transfers should be carefully managed. There should be, for day-to-day operations, there should be segregation of duty. The person, the cashier who is receiving and paying, okay, he should not have access to the day book and the ledger. Officer in cash department and receiving cashier to sign counterfile to cash receipt. There should be officer. Whenever a big receipt or payment is happening, first the officer should check whether, in case of receipt, he should check, okay, whether the name of the customer. So whenever you go to bank, guys, whenever you have to bank receives cash or pays cash, first the officer checks the slip and overall things, he approves it, and then it goes to the cashier. So always the officer should check the things, then it should go to cashier. So transaction is checked 2 times, once by officer and then by the cashier. And then there should be accounting. So cash should be custody should be safe and secure, it should be properly managed. Then the officer should be there who should approve all the receipts and payment before it goes to actual cashier. Then there should be a cashier. There should be separate set of people who should do the day book accounting, and then posting. Separate set of people separate person who goes for ledger posting. So what cashier prepares is, as he gets receipts and payment, he prepares daily scroll, okay, with cash column. So cashier prepares scroll. Then there's a person who prepare day book. Okay, scroll is prepared by the cashier, accountant prepares the day book, all the receipts and payments. So it should be independently work of the cashier who prepares the scroll. Scroll is simple list of the receipts and payments with the details. And then day book is where primary books, accounting entries are generated. So person should independently check whether the scroll and the day book, it should match with each other. Let's freeze, guys. When it comes to cash controls, custody should be safe, it should be well managed. Then we talk about daily cash transactions. Daily cash transaction, there should be different officer, there should be different cashier, there should be different person who manages day book, there should be person who manages the ledger. Okay, and on regular basis, scroll which is prepared by the cashier and the day book, it should be matched by someone else. Clearings, guys. Let's understand through this diagram. It's pretty simple, straightforward. So suppose there is a customer, he deposits check to SBI. He deposits check of rupees 5 lakhs to SBI. That SBI, I am depositing the check. Okay, please credit my account. What SBI is going to do, it is going to collect all the checks during the day and it is going to send it to the clearing system. Okay, clearing system. Now clearing system, suppose this check is of ICICI Bank. So basically clearing system will intimate the ICICI Bank, listen ICICI Bank, there is a check which is drawn on you that for 2 lakh rupees. Okay. So whatever checks go to ICICI Bank for payment, that's called inward clearing for ICICI Bank. Inward clearing. So ICICI Bank will check whether such customer is there, such account is there, whether they are having the balance, whether the signature matches. Okay. And then if answer is yes, then ICICI Bank is going to pay the amount. It is going to be called paying branch. And then SBI is going to receive the amount. It is going to be as receiving branch. So it's pretty simple, guys. So Banks which send checks for clearing, that's called outward clearing. And banks, okay, and banks which receive the checks is called inward clearing. After verification, they become paying branches, and SBI will going to become receiving branches. Let's understand this, guys. So, check handling procedure. The RBI check nowadays, all the checks are scanned, and there's a check truncation system. CTS allows for electronic transmission of check images along with necessary details to the paying branch. This process reduces cost and speed of the collection time by removing the need for physical check movement. So nowadays physical check movement doesn't happen. So SBI, the outward clearing is going to happen through CTS, check truncation system, in which images and some details are sent to the paying branch, okay, so that they can verify things and then make payments. For checks amounting to 5 lakhs and above, the branch must contact the customer via call or email as per RBI rules. Compliance can be verified by the auditor on sample basis. The auditor should ensure that check drawer signature is confirmed by the bank staff, preventing potential bank liability. Unpaid checks from outward clearing must be sent back to the customer, or they should be notified to pick them from the bank. So very simple things are there. First of all, you can see that this is, you can say, for outward clearing, and 2 points are for inward clearing. So let's understand. When it comes to outward clearing, use CTS, check truncation system, and details so that speedily outward clearing can happen. Paying branch can receive the details, and there is speed involved, and there is a less cost. Okay, electronic transfer of the information. If some check gets bounced, it is responsibility of the outward clearing branch that to send the check back to the customer, inform them, and maybe charge them penalty. So the 2 points are for outward and 2 points for inward. Whoever is the paying, the inward clearing is there, they should ensure that if the check is above 5 lakh, they should confirm with the customer before the payment is done. Okay, and then they should carefully check the signatures, whether the signatures are proper. Otherwise, wrong payments may happen, fraudulent payments may happen, and bank may be held responsible. Bills for collection, we already know. Very simple thing. Bills for collection we have already discussed. So bank receives the bill, and customer says that collect on my behalf. So bill may be received in the bank in Mumbai, and collection may be there in Lucknow. Okay, so it's very simple. The receiving branch is going to maintain all the details and registers, and then there's a collecting branch who is supposed to again play an important role of collecting money and crediting it. So they are saying that whenever bill comes for collection, the receiving branch should maintain all the details. There should be a proper register for all bills of collection received, all the bills which are sent for collection, outward clearing. Then all the collecting banks should have proper, we are talking about internal controls, strong documentation at the receiving branch, strong collection and crediting procedure at the collection branch. To ensure that bills sent between the banks are accounted twice, ensure that the bills sent between the branches are accounted for twice in the consolidated balance sheet. Receiving branches should reverse such entries at year end. Okay, so here there, listen guys. So there is a branch who sends the bills for collection, and there's a branch who receives the bill, and they do the collection. So we can use the better words, sending branch which sends the bill for collection, and receiving branch which receives the bill, collects the bill, and credits the account. Okay. So they're saying that in sending branch you should keep all the details, and bills of collection should be counted for the sending branches. It don't let counting happen twice. The bill was branch A got the bill, so it should be counted in their records and not in the records of the branch which is collecting it. Okay, let's freeze, guys. There should be strong internal control at the sending branch. Whenever bill is received, make detailed register how many bills are received, then how these bills are sent to which particular branches, strong documenting controls. Then branch B, which is receiving the bill for collection and collecting the amount, strong collection and crediting control should be there. Okay, sending branch should have strong controls when they get the bills. Receiving branch should have strong controls for collection and crediting, and it should be counted only in one branch which is getting the bill initially. So these are bill collection control. Then bill purchased. So whenever you are purchasing bill, guys, whenever you are purchasing bill, it's like a short-term financing. Whenever you are purchasing bill, it is like a short-term financing. Short-term financing. Okay. So here, always where before you purchase the bill, check credit worthiness of the person. Okay. Then see if the credit worthiness is there. Then there should be approval by the proper person. Then security should be received, margin should be received. Check whether the bill is properly having title, sign, signature, stamp. Okay. Then you purchase the bill. When you purchase the bill, there should be proper discount income. It should be apportioned. Part of the income may belong to current year, part of the income may belong to next year. On due date, it should be properly presented. If there's a default, then the customer should be charged properly. And if the amount is outstanding, a proper provision should be made. So guys, it's pretty simple. When you purchase the bill, it's a very, just like you give loan, just like you give that kind of internal control. Just when you're supposed to purchase the bill, first check the credit worthiness, then proper authorization, when first receive the security and the margin, bill should be proper. Then only you purchase the bill. When you pay the bill, you charge discount income, you apportion it properly. If there's a default, there should be proper presentation procedure. If there's a default, customer should be charged and old outstanding should be provided for. Then they're talking about internal controls about loans and advances. Internal controls about loans and advances. Okay. So first of all, guys, this is repetition. First of all, there should be strong loan policy for different types of loans. There can be housing loan, there can be vehicle loan, there can be personal loan, there can be project loans. Okay, there can be property loans. Strong policy. When a person comes, there should be strong internal control, check credit worthiness. Okay. Then credit worthiness, strong documentation should be there. Then only authorization, sanctioning, proper authorization system should be there. After authorization, get margin money, get security. Security should be registered in the name of the bank. It should be proper value. Then only amount should be dispersed. Limit should be there. Regular interest should be charged. Installment should be collected. There should be annual review of the operations, and irregularities reporting should be there. So guys, it is, you imagine how the loan process happens, and you can have more points or some points may you may not remember. That's absolutely fine, but remember the whole process. There should be complete, there should be very good policy. Then there should be internal control to check credit worthiness. Then after credit worthiness, there should be strong internal controls. Once you check the credit worthiness, there should be strong internal documentation should be there. Proper authorization should be there. Proper agreement should be there. Authorization, then agreement should be there. Security should be received. Margin should be received. It should be in the name of the bank. It should be properly valued. Then disbursement should happen. Proper utilization should be there. Then regular interest should be charged. Then installment system should be there. Installment should come. Annual review should happen, and irregularities should be reported. Many times limit 20, they are saying 20% temporary increase, 20% more than the limit, 20% inflation for 90 days, absolutely fine. So going beyond limit is allowed to limited extent. So when we talk about DD, the branch which receives the money issues the DD, they should send intimation that we have issued so and so DD, it will come to you for payment. The paying branch should ensure that the document is original, it is properly signed, it is reliable, it matches with the intimation. They should make the payment and then they should send intimation that we have made the payment. So receiving branch should have strong internal controls for issuing the DD and intimating the paying branch. Paying branch should have strong control for checking the instrument which has come for payment and again intimating bank. Interbranch account is used for interbranch operations. Important credit card. See, these guys are explaining us what kind of internal control systems should be there in general and in different areas. Internal control systems are nothing but what kind of standard steps and procedures which should be performed. Now this very famous credit card operation has been asked in exams. First of all, storage. All the unused credit cards should be properly stored. They should be properly stored. It should be safe and secured. Proper inventory record should be maintained and regular physical verification should happen. So storage should be proper. If storage is proper, next is there should be proper credit assessment whether we should issue a credit card to a person or not, and if yes, a proper limit, credit limit should be decided for a particular person. There should be strong internal control system to check credit worthiness of the person before giving the credit card, and as per credit worthiness, proper maximum limit of credit should be set for that person. Then next is, so there should be strong internal controls for storage, then credit assessment. Then when the person goes with the credit card for making the payments, so see guys, it's a very old theory. Nowadays all these things are done through system only. There should be strong internal controls that whenever goes for the payment, it should quickly check whether the card is having limits for making the payments. Okay, especially if heavy payments, if huge payments or big payments are made, say payment crossing 20% of the limit, 30% of the limit, okay, then it should be verified. Especially it should be confirmed, and it should confirm properly if in case of big transactions. So in case of big transactions, they may ensure double verification, or verification by one system and then by another system, or along with a person should also verify it. There should be strong internal control system to ensure that the payment limit is available. If it's a big payment, ensure that there's a double verification. Then once payment is done, when the payment is done through credit card, okay, there should be intimation, there should be strong internal control which intimate the bank servers, banks, that the payment is done, your payment is done, you reduce the credit limit and account for it. Then this amount should be, nowadays this happens instantly, this amount should be reimbursed. Bank should pay, once the payment is done through credit card, bank should pay that amount to the merchant, okay, to the merchant. And customers account should be charged, the limit should be reduced, customer should be charged for it. So there should be strong internal control to check the availability of the limit, especially big payments. Then once payments are done, it should be informed payments are done, and immediately customer should be charged, and then reimbursement should happen to the merchant. All these things generally happen nowadays instantly through the systems. Then ensure regular statements are generated. and sent to the customer with minimum amount due. There should be continuous monitoring. Continuous monitoring, uh, monitoring with respect to credit cards. Keep monitoring the cards where the limit, where the limit consumption is very high, where the transactions are very high, where there are defaults. Keep monitoring it. Where there are delays in payment, defaults in payment, periodically review whether we should change the limits, category of the credit card holder. See the overdue payments, and maybe there should be strong controls for classifying it as a NPA. So first, strong controls for storage, then credit assessment, then these things, then how payments are executed, then statement generation, then monitoring. Now guys, there's a very interesting thing, very interesting thing. CRR and SLR, very important from the exam point of view. Very important, very important from the exam point of view. Let's see guys. So let's finish off CRR, SLR, then we have to talk about the investments. Okay, let's see guys. CRR, SLR, very important from exam point of view. CRR is not that important, but SLR is very important. So what is CRR? Cash reserve ratio. All the banks are supposed to maintain near about 5% of the total deposits they get. 5% of total deposits they get. So they have to maintain 5% of total deposits with RBI. That is CRR. As per banking regulation, as per banking regulations and different acts, it is required for all the banks that up to 5% is supposed to be maintained with RBI. So define what is, it is backed by the legislation. Very simple, no need to go in detail, no one is going to ask, that's not important. SLR. Now, this is interesting. About 25%, what is SLR? Statutory liquidity ratio. About 25% of the total deposits which bank gets, it can be fixed deposits. It can be your current accounts and savings account, that is called as demand deposits. People can withdraw money anytime. It can be fixed deposit, that's called time. Current account and savings account are called demand liabilities. They can demand money anytime. Then fixed deposits are called time liabilities because they will be after tenure of 1 year or 2 year or 3 year or 5 year, as the case may be. So for all the demand deposits, time deposits we are getting, that's called demand and time liabilities. About 25% of that should be maintained with the bank in the form of liquid assets. And when we talk about liquid assets, so that is gold, that is cash, gold, bullion, government securities, and so on. So first explain what do you mean by SLR, and it is required to maintain the liquidity so that there is no default in payment, or reducing the risk to a very low level with respect to default in any kind of payment. Again, it's a legal requirement. Now, what as an auditor we are supposed to do, that's very important. As an auditor, we are supposed to select 12 odd dates. Very important, 12 odd dates. Now here 12 odd date means 12 odd dates in different months. That means one date should be there in each month, and it should be odd. Here odd means simply different, nothing else. So suppose in a month, in April, you are selecting day number 3. Okay, so May you select 5. So date should be different. 12 odd dates should be there, different dates should be there. Okay, and on these 12 odd dates, auditor is supposed to check whether SLR requirement is fulfilled. Okay, now How auditor is going to do that? He is going to make report, and one more very important thing, not being Fridays. Not being Fridays. See, banks follow fortnight system. Fortnight system means 14 days. And they have well defined fortnights, and fortnights they start on Saturday. They cover first Friday and then one more Friday. It starts on Saturday, it ends on the Friday. So reporting is generally done to RBI on fortnight basis, and fortnight starts on Saturday and ends on Friday. So as on Friday, don't select Fridays, because Friday reporting is done and report should be prepared, sent to the top management as well as RBI. So auditor has to do checking for 12 audits. For this checking, first go and download all the important requirements. Now what RBI says, what are the present SLR requirement, what is the percentage, what should be there in detail. We are going to discuss detail, what should be counted, what should not be counted, what will come in demand and time liabilities, and what will come in the liquid assets. Go and understand the RBI requirements. Okay. Now here, all the branches, head office and all the branches will be informed about the 12 audits. That listen guys, we are supposed to check SLR requirement for this 12 dates. So we are requesting everyone to all the branches to prepare trial balance. Prepare trial balance for these 12 audits. Prepare trial balance which is relevant for these 12 audits. Okay. Then ensure that it is properly audited and it is sent to the head office. It is sent to the head office. It is sent to the head office. Okay. If there are unaudited branches, they will be informed that it's okay. You prepare the trial balance, you check on your level, proper checking, and then send it to us. Send to the head office. So head office will get all the trial balances for 12 audits. Okay, from the audited branches, where branch auditors will take an overview and check these trial balances from unaudited branches also. So, and then they will be consolidated. For each date, a consolidated trial balance will be created. Consolidated trial balance will be created. As an auditor will check the consolidation, whether all the branches are covered, audited and unaudited, where everything, all of them are covered. He is going to check, then he is going to check on sample basis whether the data in consolidation and data sent by the branches, it matches for audited, unaudited. For unaudited branches, he may do some verification procedures. He may check few the trial balance matches with the system, with the account balances matches with the system, is it appropriate? He may perform some test. And finally, consolidation will be done. Consolidation will be done. And once you do the consolidation, you are going to get trial balance of the bank for these 12 audits. Okay, 12 audits relevant for these 12 audits. Okay. And you are going to get detailed demand and time liabilities for 12 audits. Then you multiply it with 25%. Then you multiply it with 25%, and you will understand how much liquid asset should be maintained for these 12 audits. Okay. So guys, you need to, if you get the question, you need to explain that, okay, this is SLR requirements. We are supposed to check whether it is complied with. We are going to select 12 audits in different months, not being Fridays. Everyone will be informed about it. And then trial balances will come. These trial balances are going to have details of demand and time liabilities. Okay. They will be consolidated. We will check consolidation sample basis where everything is covered. Then we'll check whether data is appropriate. We'll check unaudited branches, whether then the arithmetical accuracy is there. Then we'll get the DTL amount. Now, very interesting thing. There's the MCQ on it, that 12 audits not being Friday, and that is the base for all the for particular 12 audits not being Fridays. So they specified that these are the dates. These are the dates which are selected by the auditor, and we are supposed to say whether the selection is appropriate or not. So if they repeat the date, it is not appropriate. If the two dates come in same month, it is not appropriate. If it is Friday, it is not appropriate. That's how we're supposed to answer. Then very important is exclusions. Okay. Now, I'm all good. I'm all good. There was, and I know that there was a band on my hand. Okay. It is quite, good feeling when students care. But don't worry, it was nothing. It was simple blood test, nothing more than that. Okay. Now, exclusions. Exclusions. Now, what is exclusion? This is very, very important, guys. These exclusions are extremely important, exclusion and inclusions. So, RBI said that when you count DTL, some accounts with credit balances need to be excluded, and some accounts with credit balances need to be included. Okay. So, there's a shortcut. RIL should be excluded, says PM. RIL Reliance is a big entity. RIL Reliance should be excluded. Reliance should be excluded, says PM. That's a shortcut. R stands for recoveries. So if recovery is happening, guys, if recovery is happening from the borrower whose balance was written off as bad debt, if recovery is happening from the borrower whose balance was written off as bad debts, then the accounting entry will be cash bank account debit to recovery account credit. Now this credit balance we are not supposed to pay this back to anyone. Bank is not supposed to pay this back to anyone. This kind of credit balance should be excluded. This credit balance is not in nature of demand and time liabilities. It should be excluded from DTL. By any chance, if it is there, it should be excluded. If it's there, while solving MCQs is very simple. If it is there by any chance, it should be excluded. And if it's already excluded, no need to do anything else. Then I stand for Indian currency. So many times what happens, suppose bank makes payment of $1 lakh. Bank makes payment $1 lakh on behalf of customer. Okay. And the customer has deposited 80 lakh rupees. $1 lakh, roughly 80 rupees per dollar. I'm just taking. So say deposits 80 lakh rupees. 80 lakh rupees in our account in banks with bank. Now listen, guys. So entry pass is cash account debit to unadjusted import payment account 80 lakh rupees. So many times this happens, dollar payment is done, corresponding rupee payment is received, but debit of the payment and credit of the receipt, they're not adjusted with each other, because what should be the rate which should be used, that is yet to be finalized. Yet to be finalized means yet to be decided or yet to be finalized what should be the exact rate. So many times banks make dollar payments, and and whenever they make the payment, as per that rate is determined and intimated. It may take 1 or 2 days. So till that time, the debits and the credits, they are unadjusted. Now this particular credit, Indian currency credit balance. So bank may receive Indian currency, and when they receive Indian currency, for the foreign currency payment they have made, there can be account with the credit balance. This amount is not supposed to be paid back. It is supposed to be adjusted. So this credit balance, if it is by any chance it is included in DTL, it should be excluded. So the Indian currency received for the import payment, which is not yet adjusted, should be excluded from DTL. Then L stand for link branches. L stand for link branches. Sir, what do you mean by link branches? Banks generally have a branch. Banks generally have a branch. Okay. Generally have a branch. This particular branch is responsible to communicate on behalf of bank with the other banks, with RBI, and maybe to the corporate clients. That's called a link branch. That branch is a link. That is a link between other banks, RBI, and corporates with other branches in that area or that region. That's called link branches. Okay. So many times what happens, corporates contact link branch and they say that, okay, so suppose Reliance says that we want to pay dividend of 10,000 crore. We are giving you 10,000 crore and we are sending checks of 10,000 crore to our shareholders. They will encash it. So these checks will come to your branches across India, pay them. So many times link branches get the money for dividend payments, for interest payments, for refunds of application money, and so on. So they have an account with lot of credit balance. Now, payments are done across India. So across India, branches make the payments and debit balance is generated. When they make payment, debit balance is generated. That debit balance and credit balance at link branch need to get adjusted. Okay, needs to get adjusted. So many time link branches are going to have accounts with a lot of credit balances which need to get adjusted. To the extent of 8,000 crore, to the extent of 8,000 crore are already done. Okay, then in that case, to the extent of 8,000 is not refundable. It is not payable back to the Reliance. It should be excluded from DTL. So if there are credit balances which are not yet adjusted, though the payments are done, which is not repayable to anyone, it should not be included in DTL. On the same lines, credit balance accounts like paid up capital, reserve, PNL balances, or borrowings from RBI, Exim banks, borrowings from different banks, it should not be covered in DTL. Margin money. So whenever we give loan, before that sometimes we get the margin money so that borrower proves that he is having money. Okay, margin money is taken. Again, it is not repayable to the person. It is not in nature of DTL. It should be excluded. So RIL should be excluded. If there's a recovery money, if recovery money credit balance is there, it should be excluded. Indian currency credit balance is there for the import payments one made, excluded. In link branches, a credit balance is there which is not yet adjusted, though payments are made by other branches, excluded. Paid up capital reserves, P&L and borrowings excluded. Okay. Then margin money, again it's not in nature detail, excluded. Then few things should be included. 5 things were included. Now 4 things, new CBI order, 4 things are excluded. 4 things are included. Notes to account. If the bank has opened foreign currency account outside India with foreign branches, okay, and they get the foreign currency, there, it is in nature of deposit. It should be included. It should be included. They're inward remittances. Deposits made in foreign currency are deposits included. Inward remittances included. So look for it. Whether any deposits or remittances are yet or not yet accounted for, they should be included. Net credit balance in inter-branch adjustment account. So this amount is payable to someone or the other. If there is a net credit balance, inter-branch adjustment account included. Borrowings from abroad. If you have done borrowing from the Indian banking system, it is liability towards the Indian banking system. It's a borrowing, we don't consider it. But then if you're taking money from outside, it is outside Indian banking system. You're supposed to pay this money back outside Indian banking system. That will be included in detail. Accrued interest. Accrued interest is also a liability, needs to be payable. It should be included. New CBI order. So if Nostro accounts has foreign currency deposits, foreign currency remittances included. Credit balance in branch adjustment included. Borrowings to outsiders included. Interest accrues daily included. Then finally, once you get the final amount of detail, apply 25%, and understand what should be the SLR requirement. Then see what are the government security. Then you see how much cash is there, bullion, value the bullion, gold, value the government securities, and see whether the requirement is fulfilled, and the reporting should be done. Report should include a special mention about the branches which are not yet audited. And then nowadays banks use ADF, automated data flow. So a lot of data will be received from the automated data flow system. Okay. So take care of that. Extra point is written apart from reporting. So guys, that was a SLR requirement. Now let's talk about the asset side. So they talk about all these things. They talk about initial things, risk related things, control related things, and now they start about the assets. On asset side, you see the most liquid asset first. So if you want to verify cash, it's very simple, not very important. Physical verification is the only way to is the best way to ensure that cash exists, cash is complete, and it is proper. All form of cash, ATM, cash deposit machines, everywhere, physical verification. So on sample base does the physical verification. To verify the cash, physical verification is the best thing. Ensure that the cash in physical verification agrees with the cash as per records. Sometimes reconciliation may be required because cash may be in transit. So that reconciliation should be there. So best ways to go to verify it is to go for physical verification. Whatever cash you get, it should reconcile with the system's cash, and the item should be justified. If there's a balance with RBI, verified with the ledger. In the ledger, it should appear so much is the balance with RBI. Okay. Then bank confirmation should be taken. Okay, this is the balance with RBI. Then RBI may say that this is the balance and our ledger may have a different balance. A reconciliation may be required. Reconciliation will be required. Again, there can be cash which can be in transit. Because of that, there can be a reconciliation. The cash may be sent by us, received by RBI after a few days. Because of that, it can be there. Or RBI has given the interest on the deposit. Because of that, there's a difference. Or there can be some credit or debit entries. Okay. So very simple again, verify from the ledger, the balance, go for the reconciliation, again get the verification from RBI, reconciliation will be prepared, and this reconciling item should be justified. There can be cash in transit. If it's there within 2-3 days, within some days, within next few days, it should be resolved. You should go and see that. There can be income or expense entries, it should be resolved. If there are certain debit credit entries which we are not able to understand, okay, and no information from RBI, they are the cause of concerns. They should be marked, they should be discussed, and about what should be done about it. There can be some issue or problem with that. So if there are unusual items, we need to probe in detail, and maybe we may come across certain fraud or error. So how to verify cash, how to verify balance with RBI, balance with other banks on the same lines, nothing new, same again. Verify with the ledger, get the confirmations. If there's a difference, there should be reconciliations. There should be reconciliation. If there's something in transit, it should be resolved within next few days. If there should be interest expense entry spending, it should be recorded for. Same thing, nothing new. Foreign balances should be converted at a proper exchange rate, and difference profit loss should be booked. Money at short notice and money at call and short notice. Okay. So see, in bank there's a very unique thing which happens. We discussed this. When money is taken or given for a day, that's called money at call. When money is again taken or given for 2 to 14 days, it's called short notice. So if money is given, if money at call is given, money at short notice is given, it's an asset. So first of all, authorization generally done at head office. Okay. Whether such transactions were authorized by proper person. If it is authorized, proper documents were prepared, proper correspondence and documents were prepared, then whatever is the balance, it should agree with the ledger, confirmation should be there. If it doesn't agree, there should be a reconciliation. Ensure that subsequently it is recovered and interest is properly accounted for. So just imagine the flow. First, authorization will take place. Then transaction will take place. Then we'll verify with the ledgers and confirmations. If there is a difference, it's a reconciliation. Subsequently, recovery will happen. Okay. And then along with that, interest will be accounted for. So you think about the flow, you'll understand what things need to be checked. Now, next is, guys, investment. So first of all, investment policy. Go and read RBI circulars on what kind of investments banks can do. There should be a strong investment policy by the bank, what kind of investment they can deal with, what kind of investment they can deal in. There should be strong policy for that. There should be strong what kind of investment deal with, what should be the allocation, how much allocation should be done in different kind of securities, in different kind of sectors, what should be the credit rating of the instrument, strong policy of the bank with respect to investments. What kind of investments, what nature of instruments, what about different sectors, what about credit rating, how the approval should happen, process. There should be strong policy for that, and it should be in line with what RBI says. Like RBI says that there should not be credit concentration. You should not put all the money in few companies or bonds or debentures. So there should be strong policy first. There should be segregation of investment function. There should be set of people who do the trade. Then next, there should be set of people who do settlement. Then next, there should be set of people who go for accounting, and then there's a set of people who monitor everything, whether whatever is happening is normal, usual, as per RBI, as per internal policy. So there should be trade, there should be settlement, there should be accounting, there should be monitoring. There is front office, middle office, and back office. So trade is front office, settlement is generally middle office, and accounting and monitoring is the back office. There should be complete separation. People managing investments of the bank should be different. People managing investment for PMS client, portfolio management system clients. So people have given us money, crores of rupees, that you manage it. Then people managing those investment setup should be different. And if you're doing buying and selling of instruments for the customers, again, then that department should be different. First of all, there should be different set of people for different activities. Then there should be segregation. People managing own investments are different. People managing investment for PMS are different. People doing trading for the customer should be different. There should be strong policy. There should be segregation, and there should be proper team. If internal control, so first few points focus on the internal control systems. There should be strong internal control system with respect to investment. In that comes first comes the policy, then comes segregation of the departments and segregation of the roles. Next comes is examination of the documents. That ensure that whenever buying selling is done, there's a proper authority. There's a proper authority for buying and selling of investments. Whenever so proper approval are there, after approval, there should be contract note. Contract note is issued within 24 hours by broker whenever buying and selling happens. Then monthly bills. So there should be proper authorization. There should be broker's note. There should be broker's contract note, bills for the investment bought and sold. Especially look into the conditions of the investments, whether there is a lock-in period, whether there is a lock-in period, or there is a requirement of minimum quantity to be traded. Okay, that we need to check carefully whether they are whether banks understand it, and they are, because that may affect the valuation later. So when it comes to investment, there should be test of control, there should be strong policy, there should be segregation, there should be ensure that proper authorization system is there, authorization is done, and things match with the broker's note, everything, and convenience. Okay, now investments are there. Earnings, ensure that interest and dividend is properly accounted for. Nowadays generally online payments will be done, so check fair with respect to all the investment. If dividend is declared, and dividend should be booked when the right to receive is established. When it is declared, interest should be booked on accrual basis. There should be proper system to ensure when TDS is deducted, to ensure that there is a proper accounting along with the TDS. So if the 100 rupees the interest and 10 is DDS, so cash account debit 10, TDS account debit 10, cash and bank account debit 90, TDS account debit 10, and to interest account 100. And whenever buying and selling of the investments happen, profit loss should be properly accounted for. Guys, again, it's in sequence. First we talk about the policy, then we talk about the segregation, then we talk about buying and selling of the investments, and then the earnings of the investments. At year end, we need to physically verify the investments. A lot of investments will have the certificates. So physically verify those investment certificates. Now government bonds will not have physical certificates. Will not have physical certificate. In RBI, there is a public debt office. There is a public debt office, and it maintains SGL, subsidiary general ledger. And this SGL maintains records of the government bonds. It maintains the record. that SBI is owner of so and so government bonds, Bank of Baroda is owner of so and so government bonds, ICICI Bank is owner of so and so government bonds. When transfers happen, when government bonds are bought and sold, okay, so SGL form will be filled. SBI is going to confirm, yes, we have sold bond of 50 crores, 50 crores. And bank of details will fill up the details. Yes, we have bought the form of bonds of 50 crores. It will be sent to public debt office, and they are going to the, as per SGL form, they will deduct 50 crore balance of SBI and increase 50 crore balance of Bank of Baroda. So when we talk about government bonds, there are no physical securities are not there. Instead of that, okay, there are electronic records which prove ownership, and RBI maintains those electronic records. RBI PDO, Public Debt Office, SGL is prepared and maintained, and SGL statement is a proof of ownership of government bonds. So if something is available physically, do that. In case of government bonds, a SGL statement will be received. Explain the concept of SGL statement. The SGL is a proof that we are having government bonds. Our transfers happen with the help of government with SGL forms only. Okay. Verify investment held with public debt office. Then investment can be with custodians, high value custodians, or depositories, demat account. So if custodians ask for external confirmation, depositories ask for demat statement. Nowadays there's a e-Kuber. If you want to get the, if there's nowadays there's a e-Kuber. If you want to get the details about the government bonds, then there's a concept of bank receipts. So sometimes when you buy any security, okay, you make the payment of 500 crores, but you are yet to get the security from the bank. Banks give a BR. BR is a statement which acknowledges, okay, we received so much and so amount on so and so date from so and so bank, and we are supposed to deliver so and so securities within next few days. We are yet to have the physical security with us, for us for so and so reason, because it is with other branch, or it is not yet issued by the issuing party. And don't worry, we will give it to you. Okay, we'll give it to you within next 15 days. So sometimes instead of having investment, we'll have a BR, bank receipt, is an acknowledgement from the selling branch that okay, we have received the money and we'll give it to you. And we'll give it to you. BR should not be issued in respect of transaction. BRs, for if the government bonds are there, as such government bond, there is no physical security. Everything happens through SGL. So BR should not be issued for government bonds. For government bonds, SGL forms should be used. Okay. Sometimes it is held in the name of nominees. So some securities will be physically with us. Some of them will be with the custodian. Some of them will be depository. Some of them you will get SGL statements. Some of them you will have a bank receipts. A reconciliation should be prepared. A reconciliation will be prepared that this is balance as per books 1000 crores, physically 100 crores. Okay, with custodian we have 50 crores, with depository we have 50 crores, with RBI we have 500 crores, bank receipt 300 crores. It should match. There should be reconciliation, should be prepared, it should match. Valuation, for valuation, investments are divided in three categories: held to maturity, held to maturity, that means intention to held till maturity, held for trade, they are going to sell within 90 days, and then next is available for sale. So we should see whether RBI should detail circulars, how investment should be categorized, how should be initially recorded, how it should be valued, how frequently it should be valued, what should be treatment of profit and loss. We are not expected to know them in detail. We only know that there are three categories, and there is at what cost it should be recorded, how they should be valued, how frequently they should be valued, how the profit and loss should be treated, simply follow RBI circular. Sometimes category can be changed. You need permissions. You need permissions of BOD, Asset Liability Committee, Investment Committee, any of these to change the categories. And even the investments, if you don't get uh, payments on regular basis, interest payments or repayments, it can become NPI. No need to go in detail. Yes, shifting can happen as per the norms. We can deal on behalf of others. We need to have examine whether prior approvals for carrying out such. We need to permission from RBI if you want to deal on behalf of others. Permission from the client should be there. And incomes, we made the brokerage and commission. It should be properly. Such act has been recorded and fairly stated in the bank's financial statements. Okay. Bank should be very sensitive. Bank something wrong on behalf of customers, they will be liable to pay. So ensure it should be carefully, and if there is a liability, it is accounted for. Special purpose certificate into investment. If you are managing money for the client, for each account a separate audit should be done, and audit report should be prepared. That money was handled. That client's money was handled as per that the client's money. That whatever client statements are given, these statements are true and fair. They truly indicate that this money was received. This is how investment was done. These are the real returns. For each PMS account, a separate audit report should be prepared. So guys, a very big thing. I don't think it is they are going to ask it completely, but first having a good investment policy, then having proper segregation, then proper document for buying, then the earnings, year-end verification, valuation, broad points. You should remember the broad points. Then auditing and reporting. Bank should go for half-yearly review. 30th September, they should review their investments. Are the investments as per policy? Are they generating good returns? What are the big losses? What changes need to be done in overall policy, overall system approach? A review should be done 6 monthly. Internal auditor should do separately conduct the control of treasury transaction, and the results of the report should be placed before CMD, Chief Managing Director, every month. Bank need not forward copies of internal audit to RBI. Major irregularities observed in the report may be included half-yearly review, investment portfolio. Internal auditor should pay special attention to the investment transactions, and on monthly basis they should tell whether everything is going fine. Guys, last few things, then we'll be through with the bank audit. Then we talk about advances. If you want to first go and check the internal control of advances. Again, guys, same. You should have loan policy. They should have system for credit appraisal, credit worthiness. Then you should go for sanctioning. Then you should sanctioning, ensure that securities are received, documents are received. Okay, there should be proper terms. Then you go for disbursement, then ensure proper accounting is done, regular interest is charged, account operation is happening properly, renewals are done, drawing power calculations are done. See the system, don't need to remember, guys. There should be proper loan policy. When person comes, there should be credit worthiness evaluation. Then there should be proper authorization. Then you should receive proper authorization. Then proper loan agreement should be there. Then proper security should be received. Drawing power should be calculated. Then disbursement should happen. Then regular interest should be charged. The regular recovery should happen. There should be monitoring and proper NPA classification. There should be system for all those things. You cannot rectify that. You need to understand the flow one by one, what happens in practical life. Substantive audit procedures are simple. So once internal control systems are strong, once internal control systems are extremely strong, okay, then you go and see You just randomly select some accounts, go and see master data. Master data is data which is used continuously. Like there's a one master data of each loan, details of the borrower, details of the loan, terms and conditions, which are used again to charge the interest, for recovery, security details, and so on, where the master data is appropriate. All the loans of a customer should be under one customer ID, because we know one loan becomes NPA, all loans become NPA. Then you see where the interest. So first, master data should be good, one single customer ID, interest is charged regularly, great. So first there should be analytical procedures, whether the advances, what is the growth of advances, is it justified, perform analytical procedures over the advances. Then you go and select few of the accounts, check master data, check customer ID, check interest being charged. Focus on which accounts? All large advances accounts, and other on sample basis. Then all problem accounts, problem may be by the RBI inspection team, problem can be indicated by RBI inspection team, our own internal inspection team, concurrent auditors, internal auditors. Focus on SMA 1, SMA 2. SMA 1 is special mention account 1, special mention account 2. So all the accounts which are overdue for 31 to 60 days, that is SMA 1. 60 to 90 days, that is SMA 2. All adversely commented, restructured accounts, early mortality, that's very important. If some loans become NPA within 12 months, that's called quick early mortality accounts. Focus on large advances, others on sample basis, problem accounts reported by people, SMA accounts, restructured accounts, early mortality accounts. Go and look at the periodic statements, periodic stock statements, security statements submitted, financial statements submitted, auditor's report, security report. See documentary things for recoverability. What periodic statements say? Are they having enough stock assets? What financial statements say? What audit report? Small is periodic statement, bigger than that financial statement, bigger than that auditor's report, bigger than internal inspection report. So you talk about test of controls, you talk about substantive procedures, what accounts to focus on. This can be the question, what specific accounts to focus on. This can be the question, what document should be focused for recoverability, or overall substantive audit procedures can be a question. So guys, let's stop here.